Meet Sarah and Michael. Both are 35 years old, both are financially responsible, and both had exactly $10,000 to invest. But here's where their stories diverge. Sarah represents millions of Americans who choose the traditional path. She's conservative, risk-averse, and believes in the safety of traditional banking. The answer might surprise you, and it might change how you think about wealth preservation forever. She puts her $10,000 into a high-yield savings account earning 3% annually. It's safe, she tells herself, at least I won't lose money. Michael, on the other hand, represents a different mindset. This is about understanding fundamentals, recognizing opportunities, and making informed decisions based on compelling data. He's not reckless, but he's educated. He spent time researching markets, understanding trends, and recognizing that sometimes the greatest risk is taking no risk at all. Michael takes his $10,000 and invests in physical silver, 15%, year after year. Why? Now we come to the projection that might seem incredible, but is based on solid fundamentals. Silver is currently trading around $36 per ounce. But multiple analysis models point to a potential price of $108 per ounce by 2027. That's a 200% increase in just 3 years. That sounds too good to be true, you might think. But let me give you the catalysts that make this not just possible, but probable. First, the green energy revolution is accelerating faster than anyone predicted. The silver requirements for this transition are staggering. Second, supply constraints are intensifying. New silver mine discoveries are at historic lows, and existing mines are facing rising costs and environmental challenges. Third, dollar devaluation concerns are mounting. When people lose confidence in paper currency, they turn to real assets. Fourth, institutional adoption is increasing. Major financial institutions are finally recognizing silver's unique position as both an industrial metal and a store of value. But here's the critical point. This isn't a 20-year window. Based on current market dynamics, the optimal entry point is closing. Every month of delay potentially means missing a larger portion of this move. So what does this mean for Sarah and Michael? Let's find out by 2027. The difference between Sarah's choice and Michael's choice is stark and sobering. Sarah's $10,000, safely tucked away in her savings account, grows to $10,300, a 3% gain over 3 years. At least I didn't lose money, she says, but did she really preserve her wealth? With inflation running higher than her returns, Sarah's purchasing power actually decreased. What $10,000 could buy in 2020 for now requires $11,000 or more. She played it safe and lost. Michael's story is dramatically different. His $10,000 investment in silver, if our projections prove correct, becomes $30,000, a 200% gain. But more importantly, he preserved and multiplied his purchasing power in an era of currency debasement. This isn't about being lucky. This is about understanding market fundamentals and positioning accordingly. Michael didn't gamble, he educated himself and acted on compelling data. The question isn't whether you can afford to invest in silver, the question is, can you afford not to? But before you make any decisions, you need to understand the full picture. History doesn't wait for perfect timing. Every day of delay is potential opportunity lost. But silver's fundamentals have never been stronger than they are right now.